All right, welcome to our latest wealth webinar. I'll give everyone a couple more seconds to file in here. Look at there we go. All right. There we go. All right. Can everybody hear me? Just wanted to confirm that the audio sounds good. I've had this before where you start and nobody can hear you. So just want to confirm that. Are we not live yet? Okay, well, yeah, looks like we're all good. All right. Well, thank you all for jumping on. Excited for this webinar, which is, a little bit outside what we normally talk about, but it certainly ties into some recent trends that are happening in the broader economy, both positively and negatively, and we're going to kind of cover that. And obviously, interest rates are higher, and real estate is shifting. The landscape is shifting. So we wanted to kind of do an overview of what that means for investors, both if you have just single pieces of real estate assets or you own real estate via some sort of vehicle like a REIT. So we're going to dig in all of that. It's going to be myself and Luke, just like our last webinar. We also have a special guest, Kent. He is an expert in what's called a DST, which we'll dig into the details later on that, which is a great vehicle for certain people that might qualify if you have a lot of, say, equity in your properties or any other appreciated asset, which we'll dig into a little bit later. So our overview today is going to go. We're going to look at the economic backdrop. Luke's going to cover all things about REITs and that part of the investment universe when you're looking at your portfolio. I'm going to cover some trends in the commercial and residential markets, and then we're going to have Kent cover deferred sales trust. So let's start off with the economic backdrop. We did this kind of in March. Some things have changed, but some things have stayed the same as well. Now, the main thing would be housing has had a bit of resurgence. Rates have pulled back a bit, and it's not existing home sales that have resurgence, but the new home sales. And you saw starts to hit the highest levels, highest month-over-month increase since January of 1990 on a total number basis. You see, this is on the bottom right. That's the chart there. On a percentage basis, it kind of equals where we were in a few months over the past decade, but on a just total amount, that's the record since 1990. And all of this is driven by dynamics of which we're going to talk about later. Low inventory and just new homes being the inventory that's hitting the market, and that's why the home builders are doing so well. Fiscal deficits are also continue to be at high levels and improving a bit, but not dramatically. And so all of that is tied into entitlement spending and interest on the debt, right? The Fed raising rates, the cost of debt rising dramatically. And when you have over $30 trillion in debt in the US, that means there's a lot of debt for the government to pay interest on. And so that interest is a form of spending and going out there into the economy and helping the pocketbooks books of those who have savings, who haven't had much interest coming in from their savings at all, especially if you're a retiree, low rates on, CDs and bonds, et cetera, for over a decade. And now that's kind of shifting. And so that's another aspect that continues to drive keep the economy relatively afloat. So that a lot of it is coming from the government sector. COVID and the banking crisis, obviously, the history of Fed is that when there's a crisis, they're quick to react, increase liquidity, and that's what you saw back in the during the COVID era, as well as last fall with the problems in the Bank of Japan, the Bank of England, and that has been some. Real quick. Sorry about that. There we go. And so this is something you should expect, right? Where you have the regional banking crisis, and the Fed came in and provided liquidity there, and then you had since then you've had a bit of a contraction in regional bank lending, which is concentrated in mainly the commercial real estate market, which we're going to get to later once again. So the Fed has clearly pivoted to a degree. They're talking about higher for longer. They've paused this last Fed meeting, but you can see here on the top right, there's an 81.8% chance that they're going to raise rates 25 basis points next month. And that can shift, that continues to shift, obviously, as economic data comes in. But when you see housing starts go up this much and unemployment remain relatively low, and the jobs market, while weakening, still is fairly robust, that gives more room or reason for the Fed to at least jawbone at the bare minimum. That's what at the bare minimum they're doing. They're jawboning that rates will go higher with the optionality to continue to pause and keep rates higher for longer, probably once again until something breaks. And a lot of people focus on the interest rate, but it's really about liquidity dynamics behind the scenes. And that's kind of more important, to be honest, when it comes to asset prices. Now, obviously, the impacts on the broader economy, that's more where the interest rates lie. So they're fighting year-over-year inflation is likely to continue to decelerate in the back half of the year, especially because inflation peaked kind of month over month in the summer of last year in June. And so what is it now? We're in the month of June. We're going to start getting that June data here next month before the next Fed meeting, and that's likely another stair step down in inflation. So once again, this won't be the last time that the Fed is trying to battle between fighting inflation and creating what would be a hard landing. So far, they've avoided it, and I think they will continue to keep rates high as long as there is no hard landing. But as we've seen before, if there is a harder landing, then they'll go into more concerted easing. Now, demand in the economy remains weak in the manufacturing sector. Okay, so this is the dark line is 46.9 is the Purchasing Managers Index in regards to manufacturing. And the non-manufacturing, that's at about 50. So that's right, no contraction, no growth. And the majority of the economy is in that non-manufacturing side, right? The services side of the economy. So you could call the economy and demand a bit neutral year over year, which, remember, you're coming from a high level though. And that's something a lot of people are not understanding, is that you are, a lot of what's happening in the economy is mean reverting. So it's not into a depressed state, more of a reversion to longer term averages. Industrial production, same thing, right at about 0% growth year over year, reverting back to longer term averages, nothing too depressing. Real final sales, retail sales, that also kind of at stall speed. And inflation figures continue to come down, right? We're at right about the 4 level on the consumer, the CPI. But what you can see here is the producer price index, which eventually will feed into the consumer price index, right? There's a lag effect there. That one's already down to 1.22, and that peaked near 12% back in the spring of last year, whereas the CPI peaked in the summer of last year in June. So there's about a 2 or 3 month lag. So when you see this down here in the 1.2 handle for the PPI, that's once again, that's what you're likely to see somewhere in that range 3 months forward. So that's why we continue to say that inflation, at least near term, due to high interest rates, due to a more aggressive Fed, is going to do much better at bringing in that inflation. A lot of that has to do with M2 growth coming down as well, and now in negative territory. Now, yield curve has shifted. These are different dates, but what you can see here is that the light blue bar, that was August of last year, And the dark blue bar, that is June of this year. And what you can see is this is becoming more inverted. So this is the short end of the curve and then the long end of the curve. And you see when that light blue bar is above it, that means it's a steeper curve. And that dark blue bar is lower and is showing that the market continues to price in a weaker economy going forward, which means more Fed easing in the future. And this is the 210 spread. This has been negative really since, what was this, the last summer? And so we're about going on over a year of, excuse me, not last, yeah, last summer. Yeah, there we go, last summer. And we're going on a year of this inversion, and it should continue to get more and more inverted, with the market pricing in a recession. And this is one chart I continue to watch. This is kind of the stability in the bond market, and that's really what drives the overall liquidity within the system. And when this is kind of the volatility of the bond market, and when this rises above the 150 level, it happened in the fall of last year, it happened during the the banking crisis in March, and that's when the Fed tends to step in, try to quell any volatility within that space, and so far they've done a very good job in keeping that well below the 150 line. So I continue to watch that to see what the liquidity dynamics in that bond market are. And with that, that's a broad overview. We're going to get into some more details on the real estate market now, but I want to pass it over to Luke, who's going to talk a little bit about REITs.
Thank you, Justin. Just want to make sure you can hear me fine.
Yeah, you're all good.
Fantastic. Well, thanks again. And before we get into the dynamics underlying the commercial and residential real estate market, I'm going to briefly touch on public and private REITs and kind of the benefits of adding them or monitoring them and bringing them into your portfolio. So moving on to the next slide, I wanted to kind of frame the different types of real estate investments you can make in public equity markets into two different subgroups. So on the left, you see these equity REITs, which we're going to be discussing. And on the right, you see real estate management and development companies. And there are some big differences between these two. Mainly that real estate companies themselves kind of generate their revenue through development, sales, through leasing, through construction, and that's not really how REITs work, right? REITs generate the revenue through rental income, interest on mortgages, passively managing the properties that they own, right? And REITs are typically structured as trusts or structured as companies, and they have special tax considerations and distribution requirements that make them very different from these typical real estate operating companies, and that's something we're going to talk about in a little bit. But really, the key here is that REITs, it's really a structure that's formed to generate income through the properties that the company owns, while these real estate operating companies can kind of take many forms of business. And the real reason that we want to consider REITs within our portfolio, as you can see on this next slide, is kind of the diversification benefits. So how do you look at diversification? Well, you look at how different assets that you fit into your portfolio are correlated. And this chart is showing the 5-year correlation trends of various asset classes versus the U.S. equity market. So you see core bonds, corporate bonds, treasuries, you can see U.S. small cap equities on here, and you can see U.S. REITs. Well, really what I want to draw your attention to, because a lot of investors kind of consider REITs to be similar to equities because they're traded in the same way, the public ones, on public equity markets, but that's not really the case. So this is segmenting the first 2 decades of the 21st century into 4 different periods. And you see in the first period, the third row from the bottom, US REITs correlation to the overall equity market is at 0.45, which is relatively low and very low considering, most people consider them to be similar asset classes. But you see that US small caps, the row below that, have a almost 0.9, 0.95 correlation, meaning they're very correlated to, US large cap equities. And so really what this is showing you is that US REITs are not as correlated as you would think to other types of securities traded on public equity markets, because they really do represent a different asset class. Now, kind of before we get into the difference between public and private REITs, I think it's important to kind of go over the basics of REITs, which we kind of lay out on this next slide. So we want to discuss, what is a REIT? How does it operate? What are the tax implications of owning REITs? What are the benefits of owning REITs over owning individual real estate? And then we can touch on, public and private REITs. But really, as I mentioned before, in essence, a REIT is a company or trust that operates. Can you roll back, please? A REIT is a company or trust that operates income-generating real estate properties and distributes that income to investors. And there actually is a distribution requirement legally for the REIT to maintain its tax pass-through benefits, and that's 90%. So you see, relative to other companies, or rather other investment opportunities in the public equity markets, REITs offer income in a way that a lot of publicly traded companies do not. They operate generally by acquiring and managing income generating properties through debt or equity financing. So keeping a particular eye on how much debt REITs use, especially in a rising rate environment, is very important. But it's also important to note that they may not be right for every investor, and they may not be right for every investor account, and that's because the dividends are treated differently. So when you think of most US companies, most of the dividends from US companies are going to be qualified dividends, meaning they have a lower tax rate. But REITs are treated as non-qualified dividends, meaning they have a higher tax rate. So that's something that investors should consider when deciding whether or not it's appropriate for various investment accounts. And what really is the benefit of REITs over owning individual real estate comes from the diversification, right? The diversification of revenue streams. You can own different types of REITs that operate different types of businesses. The geographical diversification, which Justin will talk about a little bit about the dynamics playing out in local markets in real estate, so that you're not just focused on, what happens in Minneapolis, St. Paul, or Austin, Texas, or Seattle. You can diversify geographically. But more importantly, I think if you're trying to get exposure to leasing properties, no one in their retirement wants to be a landlord. Nobody wants to deal with annoying tenants. I'm probably an annoying tenant myself sometimes, so I could imagine people don't want to deal with me in their retirement. So certainly being able to access these type of investments through real estate investment trusts and having an equity stake in those businesses rather than managing it yourself is a lot better for many investors. And really, you can access these types of investments with public REITs or with private REITs. So, let's talk about public REITs first. So these are the REITs that most investors are going to experience. So typically, the most exposed somebody is to the real estate market is their residential property, their primary residence, and secondarily is going to be through public REITs. So public REITs are traded just like equities on the public equity markets, which means they are incredibly liquid. It also means they're very transparent, right? There's filing requirements for transparency, and they're professionally managed. You don't have to do it yourself. They also generally, relative to private REITs, for reasons we'll talk about in a second, have lower fees. But because they're traded publicly, that means they are subject to immediate supply and demand pressures based on macroeconomic conditions, meaning that relative to private REITs, they tend to be a little bit more volatile. When people need to access liquidity quickly, this might be something they sell, so the price is a lot more affected by the dynamics of the market in the immediate term. And the investors have limited control over management. So some private REITs are structured as a GPLP structure, and they can have more control in the companies that those private REITs are buying and operating. Private REITs, though, tend to be a lot different. So if you move on to the next slide, private REITs are not traded on public exchanges. There could be private REIT offerings. They tend to be closed. And because of that, they're far less liquid and have higher fees. Because you're not trading on public equity markets, there can be sales charges, disposition charges, all sorts of charges that make buying and then eventually selling these types of investments a lot more costly and a lot more difficult. One other con is that they lack transparency because they're private investments. Think about the difference between public and privately traded companies. The filing requirements are different. But because they aren't publicly traded, they tend to be less volatile because the value of this investment is more tied to the underlying assets that the company owns rather than the supply and demand dynamics that are going on and the liquidity dynamics of the market. But these tend to also not be for everybody because there can be minimum investment thresholds. There can be qualifying requirements in order to invest there. So typically what people are going to be able to add to their portfolio and gain the diversification and income benefit are going to be within the public REIT space. Now, within the REIT space, as previously mentioned, there are many types of businesses. And really over the past 2 decades, going up until 2021, this chart is showing how those various subgroups within the overall REIT group have performed relative to not just the S&P 500, but relative to each other. And the importance in understanding this, as I've mentioned the top 5 performing ones over the past almost 3 decades going to 2021, is that not all subgroup is going to be affected by market dynamics in the same way. And that's because they have different underlying businesses. You have self-storage REITs, which came out on top, that offer storage to individuals, storage to companies. It has a lot more sticky asset base. I think we all, have experienced at some point in our lives using self-storage facilities, sometimes for longer than you need to. You have industrial REITs, which are going to be moved by the dynamics of deglobalization as people shore up supply chains with industrial properties and warehouses. Residential REITs are going to be more affected by the residential real estate market. Healthcare REITs may be affected by the healthcare market as they go towards owning and operating hospitals, and retail, REITs are more focused on shopping malls, which are going to be affected by the overall demand dynamics of the economy. So it's important to note that not all REITs are made the same, and that different subgroups are going to be affected by the macroeconomic headwinds a little differently. But really the title of this webinar and what we were talking about today is rates and real estate, okay? So why is this an important part of the discussion now? And as we already showed in that the correlation is lower than other publicly available equities with the equity markets, there's also correlation differences relative to bonds, right? So in times of economic tightening, in times of Fed tightening like we are in right now, you can see that the correlation is far lower, negative even, with bonds than it is in positive times. And because we are in an era where we are going to be higher for longer, as the Fed has just said again today, it's possible we have 2 more rate hikes in a row. It's more important now than ever to consider putting this in your portfolio and gaining the diversification benefits. So really, what should you be looking at when you're deciding between REIT opportunities? Well, just as Justin and Steve and myself always say, debt levels, not just with individual companies, equities, public equities, but you should also be considering debt levels with REITs, because as interest rates rise, highly leveraged businesses become less attractive. You have to be able to service that debt. If your primary way of financing acquisitions is debt because your internally generated revenues is not much, or you can't raise equities, it's going to be more difficult for you to expand. You should be considering the macro environment. In a world post-COVID where fewer and fewer businesses are working in an office, Justin and myself today working from home as an example, office REITs might not perform as well. You should keep in mind that specialized REIT segments give you different types of investments. Self-storage, as we mentioned before, office, as I just mentioned, tower REITs. But most importantly, you should be looking to make sure that the tenants of those REITs in those properties have profitable underlying businesses, right? So consider in an economic downturn the difference between shopping malls and the mom and pop stores in shopping malls being able to pay rent versus casino REITs, which typically, whether or not the economy is good or bad, casinos see good revenue. And lastly, you should be thinking about diversification, not just regionally, like I mentioned before, but also tenant diversification. You don't want to be too concentrated on a couple tenants who, if they face economic trouble, then the REIT itself has, poor performance. So with that, in order to kind of inform and understand better the dynamics of the real estate market and how that affects not just REITs, but maybe your other types of investments, Justin's going to talk about commercial and residential real estate for a little bit.
Yeah, before I get into that, I want to, let's pull my, let's see, where am I? There we go. Get my camera back on. Yeah, before I dig into that, I want to give that example of that region and tenant diversification that Luke was talking about. A good reminder for me is always MPW. That's one I've had a lot of calls on the show over the past year. People are chasing that yield, and the top 2 tenants were on the brink of bankruptcy, and they've been kind of dealing with that, but you see the price collapse because of that. And so that's just one kind of example of people chasing that yield and not understanding what Luke said, which is the underlying business dynamics of their tenants, which for that particular one were poor and concentrated, which is a bad combination. So you can always look that up and see what kind of return that's had over the past couple of years due to that risk. Now let's dig into the real estate dynamics that we're seeing. I have I'm going to try to go through this quick because I want to get to Kent. But what's happening
Justin,
in residential?
before we move on, I just wanted to answer one question that came up in my section, which was how and why do public REITs sell their REITs when investors are risk-off mode? What I was trying to say, what I believe the slide was saying, was that when investors are in risk-off mode, They are
Yep.
far more likely to sell risky liquid assets where they don't have to take large discounts on their positions. And because REITs are publicly traded and are more liquid, that tends to be one of the areas where investors sell. And therefore, the underlying value of the property may be less of a component of the REIT's value than the supply demand liquidity dynamics at the time. Sorry for the
Yeah,
error.
and it just goes back to that old saying that when volatility increases, the correlation of most publicly traded assets goes to 1, right? So
Yep.
people have margin calls and they have to liquidate assets, and some of them own REITs that they are forced to sell, and ultimately that creates that kind of near-term volatility that Luke was talking about. All right, well, let's pivot over to what's happening in commercial and residential real estate. And we'll start with residential. That's what the area that most people are then dumbfounded about, right? Because everyone says, oh, interest rates are going up and the economy's slowing, and everyone has PTSD and think it's 08 all over again. But I say this time after time, if you study the history of market downturns, economic downturns, the catalyst for that for the next one is very rarely the catalyst for the previous one or even the previous few. You know, it's usually things that most people haven't experienced themselves for many ever, and they take the eye off the ball and ignore the risks because they've never felt those risks. Okay, but as of late, over the past 15 years, we felt the effects of a bad real estate market. So those involved in the real estate market have gone through jump through hoops to try to avoid a calamity like that, not just companies, but also on the government level as well. So what you've seen is inventory remain relatively low. We saw that big stair step lower during COVID, and it started to come back, but still, look at where we were pre-COVID. We were somewhere in the neighborhood of 900,000 units, and we're still hovering around the 450,000 units. So about half as many units for sale than we did pre-COVID. Okay, and the new listings this year. Look at these different years. And it's not like that's improving dramatically. New listings aren't coming on board, and the main reason is simply this: golden handcuffs. This is the percentage of outstanding loans or mortgages at various interest rates. So what you can see here is below 3%, it's nearly 40% of loans outstanding. If you go below 5%, or below 4%, I think it's somewhere around 70 something percent of loans that are below 4%, and 90-ish percent below 5%. Okay, so when you have mortgage rates now hovering in the 6.5 to 7% range, very few people are willing to give up that mortgage for the 3 or 4% mortgage for a 7% mortgage. It just doesn't make sense for them. So a lot more of them are staying put. They're finding ways to remodel their home, make that particular home reasonable for them. A lot of them are renting out their homes, right? Even if they might go buy another home, but they're keeping that home as a rental. So that's not going on the sales market. So they're the attractiveness of this low debt that so many people, fixed debt that people are holding, is preventing from new homes from coming on market. And you can see here on the right is this is the refinance application level index. So refinancing. And you can see here is continues to hover near multi-decade lows, because why would you refinance when the new mortgages are hundreds of basis points higher? And this means that we're in a seller's market. We continue to be in a seller's market. Now, it's been improving once again a little bit, but not that much. And you can see here on the right side, you have the existing home month supply. So what it's doing is taking the amount of inventory out there divided by how many sales there are per month and how long would it take to go through all the existing inventory. And right now, that is 3 months. And historically, a more balanced market is 4 to 5 months. And what you can see here, back this spike over here on the kind of in the middle of the left, is the late 2000s, 2007, 2008, all the way into 2012. That was 8 to 12 months, and that is well above the longer term balanced market figure. And that's why you had prices plummeting in that era because there were way too many homes on the market for the amount of buyers. And right now, while that is improved from we were I think below 2 in the depths of I think early last year, we've improved all the way to 3. It's still a seller's market. Anytime you're below that 4 number, you pretty much can say nationally at least you're in a seller's market. Sorry, you're in a seller's market. And on the left, what you can see is we have not been building nearly enough homes. So the blue line is the amount of occupied homes, okay, and the orange line is new homes being built. So during the housing bubble, you had way too many homes being built for the amount of homes that are being created or households that are being created. As of the last, call it 10 years or so, we've actually been underproducing homes. You can see the demand for homes as a lot of the millennial generation, which is the echo of the boomer generation, they have been moving into their own, right, graduating college and buying homes. And so we have a situation where we haven't been overbuilding homes and we don't have a good amount of inventory on the market. And so that's kind of nationally. Now, regionally, that's more important, okay? Here's domestic migration trends. And on the left, what you can see is that moving out of the large areas. So the blue box, the blue candles, I guess you can call them, would be over 1 million in population. And you can see the Pacific division, West, North, Central division, so the Midwest, the West, the Midwest, and the Northeast. That's where people are moving out of large city centers into rural areas. That would be the really dark blue, and you can see that here in the South, right? A lot of people are moving to smaller cities in the South. You can see that with the dark blue, the orange, and the gray. And that's where most of the people are moving. And US net population year over year from 2021 to 2022, you can see out of California, Oregon, places like Louisiana, and into places like Texas and Idaho and Florida and the Carolinas. So that's where most people are moving. And there's a lot of regional dynamics that are going on. So this is also from 2020 to 2022, the population increase or decrease. And you can see on the right, you have New York, Illinois, Louisiana, California. Those are by far the worst, and mainly because of net domestic migration. You see those big red bars here on the right for those 4, and a lot of that has to do with moving out of big cities. Think of New York City, Chicago, Louisiana, New Orleans, as well as California, both the Bay Area and Los Angeles and Southern California. And people are moving into, once again, places Idaho, Montana, Florida, Utah, South Carolina. All of these are mainly because of net migration, some because of birth, right? Utah, a lot of births there, a lot of births in Texas. But overall, these are dynamics that will likely continue to play out as the work from home trend continues. And this is more of a broad map you can see. So net negative migration from 2021 to 2022 here in the Bay Area, Southern California, Seattle, the Northeast, right? Boston and New York areas, and into Florida, into the Carolinas, into Texas, into Arizona. And those trends, once again, likely to continue. Now, that's more regional. Another broad question that I should say that could bring the market more back in balance and back into a broadly buyer's market would be the vacation rental market. This has been a hot place for people to invest their money, borrow money, leverage up their money, and try to get these double-digit, sometimes up to 20+% returns on vacation rentals if you do it in the right area, you manage it well, your property is attractive, etc. And that did very well during the pandemic, post-pandemic, as people were trying to travel in a big way. But recently, that has started to weaken. Outside of the Rocky Mountain area, what you can see is occupancy rates are now down double digits in almost every region. And so that's weighing on the RevPAR, revenue per average room, that's the acronym. And you can see down 28% in the Midwest, down 30% in the Southwest, down double digits everywhere except for the Rocky Mountain region. And it's just showing that the vacation rental market, it is cyclical. And as the economy continues to weaken, everyone kind of had their big surge into vacations once everything reopened post-COVID, and now that's pulling back. And so could there be a decline, some of these short-term rentals coming on market as people can't afford the debt that they've laid on a lot of these properties? I think that's where the biggest risk lies, with a record number of short-term rentals last year, up to 1.4 million. And what you can see here is that the dark blue line, net reservations per property in the US, is starting to decline throughout the year. It's starting to show a bit of an increase as of late. So something to watch. It's not enough to say, okay, that's going to crash the market near term or anything like that. But certainly there is probably too many vacation rentals out there that likely need to come back on market. So the residential dynamics are, once again, low inventory. That's keeping price declines modest. New home sales are making up about 30% of all home purchases, versus longer term is typically 10 to 15%, closer to 12% on average. And so that's why the home builders are doing so well. And the story, once again, is local. Domestic migration and whether vacation rental market will strengthen or weaken will certainly be a big factor in that. So the outlook for residential real estate is inventory is likely to gradually rise, just as it has over the past year, but it's going to take a long way, take a long time before you see a market where you're seeing huge price declines. You're already seeing price declines, but they're mostly in the single digits in most markets. I think only the Bay Area would be in the double digits year over year. A lot will depend on the strengths of the local job market, whether or not that they're creating jobs. And remember, this is not 08, low default rate still because of that low carrying cost, that low 3% mortgage that most people have, and people still have a job. So if you can afford your mortgage and you still have a job, you're probably going to continue to pay it. And longer term, real prices on a real basis are likely to remain stagnant, which you can see here. This is a chart going back to 1870, and the blue line here is the most important. And what you can see is the period where interest rates started to rise from 1950 all the way into basically 1980, that 30-year period. Typically interest rates go in a 30-year cycle up and down, and we just finished an extra long cycle. It was close to, closer to 35 years from the peak in 82 to the trough in interest rates. And what you saw in that period where interest rates went up, real home prices basically stagnated from 1950 all the way really until 1990. Okay, and so this is telling you is that this is not going to be the last 30 years is not going to be the next 30 years in home prices. It's very unlikely from a price performance standpoint to be that strong. And so if you're expecting home prices to do much more than inflation, you're probably in for a rude awakening. Okay, so it's going to be much more important to focus on cash flows if you're an investor, and the carrying costs are going to be higher, right? Higher mortgage rates, as well as maintenance. I think we all have experienced trying to get things done in the post-COVID era. It becomes a lot more difficult and more expensive to get people out, to get things done, et cetera. Now, on the commercial side, there are different markets that tend to be stronger, and we're going to look at industrial. You can see the low vacancy rate here, many markets less than 2%, and a lot of this is in the Midwest. Think of Midwest and the South, right? You have Texas, Tennessee, Missouri, Florida, few in California, New York, et cetera. But rental growth is happening here: Florida, Arizona, Ohio, Nevada, and that's where many companies are deglobalizing and bringing back their supply chains and onshoring their supply chain, shall we say, and a lot of that is happening in these regions over here on the right. So in the industrial space, that's where you probably want your REITs, or if you're going to buy an actual industrial property, to be. And the biggest headwind will be deliveries, right? Here's the forecast for deliveries and demolitions over the next number of years, and you can see how these are cycles. When there's a lot of demand for a particular type of property, builders and developers tend to go in and try to produce those, and you see record supply coming up over the next few years. So that's probably the biggest headwind going forward, and you can see that the vacancy rates on various types of industrial properties are expected to increase for because of a weaker economy, but also because of that increased supply coming on market. So that would be the biggest risk in the industrial space, although right now it remains relatively strong. In the multifamily sector, once again, the one on the left, you can see the low vacancy rates here, mainly actually in the Northeast, but rental growth is happening in the Midwest and the South, Tennessee, Florida, South Carolina, North Carolina, et cetera. The vacancy rate is starting to climb back up. Remember, rent growth was up so dramatically. You can see that here on the right. That has started to level off, and actually quarter over quarter has started to tick negative. So in the multifamily market, certainly showing a bit of sign of weakness, and a lot of that has to do with new supply coming on market. Look at the amount of homes, multifamily apartments that came on market in 2016, 18, 19, and here in 2023 and 24. And I think that's likely to weigh on rental prices going forward. In the office market, obviously that's where the biggest problems lie. And the best are in the South. Look at all the Floridas here, Utah is another one, Nevada, Texas, South Carolina. That's where the best rental growth is. And same with vacancy rates here on the left, all down below. This net absorption, this tends to be based on size, so I kind of ignore this middle one, so don't pay attention to that. On the broad markets, you see vacancy rates in office continue to power to multi-decade highs on average, and you can see where it's pretty much concentrated. Here in the Silicon Valley area, you see it a little bit in the Northwest in Oregon and Washington, but also the Northeast as well. That's pretty bad. And parts of Texas, look at this big one. This is Austin, Texas here on the right, and those vacancy rates are increasing because a lot of people, once again, they're moving out of those city centers and into the rural parts of the market. And so office continues to struggle. The vacancy rates since the pre-COVID era, 2019, the worst performer, San Francisco, 10.3%, and San Rafael, just north of the Bay Area at 6.2%. And the best, you have Florida, Washington, Louisiana, Florida, New York, Texas, different cities, but mainly in that Texas and Florida region. And you can see San Francisco vacancy rate up approaching 30% as of now. All right. And then lastly, retail. Retail continues to be strong in the South. You're seeing a lot of common themes here. The strength in real estate, more broadly commercial and residential, is in the Midwest and the South. And then you see vacancy rates. What's interesting here on the retail side, let me go back, is this one on the left. And what you can see is this light blue line, or I guess you could say greenish blue line on the bottom here. That has started to tick up really since 2018. And through the pandemic the vacancy rate started to increase. Those are your typical malls. So malls continue to struggle. What continues to actually do fairly well? Your neighborhood, community, and strip malls. So think of restaurants and your standard grocery stores, et cetera. Those continue to do very, very well. And power centers. These are your big box retailers, your Targets, your Walmarts, your Home Depots. Those are doing very well also. So if you're looking at REITs or to invest in the commercial real estate market, you want to continue to stay away from the mall sector and more towards those community strip malls and big power centers. And what you can see is the rental growth has started to tail off for retail overall as well. So these are the commercial dynamics, right? Onshoring tailwinds, retail strip malls doing very well, multifamily weakening with record new supply coming on this year and next. And once again, it continues to be very localized. Now, office is very weak in large markets, especially the Bay Area, but tends to be strong in some of those smaller regional markets. And the outlook going forward is office will remain under pressure for many years, especially in those big markets. Industrial will remain the best sector, we think, for investment, whether for a REIT or an individual piece of property. And you can see here is new CMBS maturity defaults. 70% is in office, 22% retail, and very low defaults elsewhere. And multifamily will have regional changes, just like it is more domestically or more in the residential housing market. And retail remains cyclical. The B and C malls will continue to die I know we had one here locally. It's called the Laguna Hills Mall. That's been basically torn down and changed. But the bigger malls, the better ones, Fashion Island and South Coast Plaza, Irvine Spectrum, those are kind of our top end malls. Those remain very strong. And so I think that will continue. And then there's the strip malls, big box remain pretty steady. And future lending remains pretty murky. You see here on the right where this is the net percentage of domestic banks tightening lending standards for commercial real estate. That's at 67%. 2/3 are tightening their lending standards because of what's happening in the underlying market. So was this going to be the last slide? I think this is going to be, oh yeah, this is going to be the last slide. Okay, yeah. So the bottom line is that most investors, they have their largest real estate position in their primary residence, maybe some REITs, and some rentals, a lot of individual rentals that you might have, whether it's on the commercial or the residential side. But both of these trends tend to be mixed based on local and national dynamics. So you have to really consider those if you're going to be holding either long-term. And the cost of capital really changes the risk and reward dynamics, and you're going to see that play out. You've already seen that play out in the trends within the equity markets. So those secular headwinds and tailwinds are going to be very, very important when you're understanding whether you should hold an asset like work from home, deglobalization, et cetera. And most importantly is this bottom one. You have higher interest rates and inflation have changed the dynamics of the real estate market going forward, likely for the next couple of decades. This is not the 80s, 90s, and 2000s and 2010s anymore. This is the 2020s, 2030s, probably remember, this is typically a 30-year cycle where interest rates rise. And at best case, you're gonna have interest rates probably stay flat from here. But that's also unlikely as well due to an inflation dynamic. So the question is, are you okay with your exposure? So I think that transitions me over to Kent. Let's see, I'm gonna turn his.
Justin, there's one question that came in
Sure.
before we move to Kent, and that is, what do you think the effects of the current commercial real estate concerns with loans and vacancies would have on healthcare tenants that require commercial office space, specifically dental offices? For example, my partner is in the process of buying a dental office that has a 10-year lease with 2 years left. Would she be in a better position to negotiate lease conditions since commercial landlords may be hurting for tenants, or should we be considering about being a commercial tenant going forward? Not sure if it helps, but the dental office is in a commercial building that currently has 6 to 7 tenants with 3 vacancies in Austin, Texas.
Okay, good question. I like this. This depends on how that particular office or that office building is zoned. I know this very well. I set up my fiance's medical practice, and it's all about what the city will allow in that particular building. And so if that is a building that has a bunch of just standard offices as opposed to just entirely healthcare, then obviously there's going to be pressure on those other offices, and they're going to be wanting to probably turn that entire building into healthcare. And obviously maybe other buildings around it are going to be pushing more towards healthcare, which is a steadier type of tenant versus offices. So in general, yeah, you probably are going to see weakness in the broader commercial real estate market if office is weak. But once again, that could depend on where it is, right? You're in Austin, Texas. Yeah, I guess that would be probably under pressure for rental prices. So I would consider that to be a risk that, hey, the landlord is going to have a tougher time filling that space, especially if the city is allowing maybe those other offices to transition to other types of businesses and zoning. So something to consider. All right, let's pivot over to Kent. I'm going to make Kent the presenter. There you go, Kent.
All right, super. Well, good afternoon, everybody. I really appreciate the opportunity to share some information about the Deferred Sales Trust. This is a tax deferral structure that is ideally suited for those who own these fixed assets, real estate businesses, and so forth. It's a strategy I've been using for a number of years and have greatly benefited by it. So I hope with the information I'll share today that you'll discover another tool that you probably didn't know much about before today, but you'll be able to either utilize it or share it with someone you know who will be able to take advantage of it. Just briefly, I'll share a little bit about my personal background because it is, part of the real estate.
I don't think you're sharing your screen. There you go. There we go.
We're on? Okay, good. I initially had a corporate finance career during the beginning of my career, and then in 1998 got into real estate, and that involved acquiring and managing here in the Minneapolis area a large residential real estate portfolio with some partners. Part of that we acquired a We Buy Ugly Houses franchise and flipped over 400 properties and moved a lot of those into a rental portfolio as well. And then approaching the 2008 crash in 2006, 2007, we could see that the market was going to roll over. And so we sold all of those properties very quickly, and we paid an enormous tax bill. And I vowed at that time that I would never get myself into a situation where I was paying a significant amount of tax when it was time to sell. After the crash, 2009, we started buying and developed again a couple of real estate portfolios that at its height were valued at about $9 million, again with some partners. I currently serve as the managing partner for those portfolios here in the Twin Cities. Part of real estate has allowed us to give back. We've been able to provide housing to nonprofits who are working with homeless teens, vets, sober houses for women, and a lot of really good causes. And so it's been fun to utilize real estate to help other people to get back on their feet and to make a difference in their lives. About 5 years ago, my partners and I were looking for a way to be able to exit some of our real estate. And in the process of looking at various ways to do that, I discovered the Deferred Sales Trust, which I began to use after vetting it with my tax attorney and my CPA. And to date, myself and my partners have sold over 25 buildings personally using the strategy. And it worked so well, and so many of my colleagues had not heard of it, that I went back to the company who created it, which I'll talk about here in just a moment, and became a trustee for the company. So I provide education on how to utilize this strategy in your own personal business or life to be able to grow your income, defer your taxes when you sell, and to create wealth for you and your family. So briefly, we'll be talking today about who's the estate planning team, what is the Deferred Sales Trust, how does it defer capital gains taxes, a little bit about the history and the benefits of using one, and how to find out if it's the right solution for you or someone that you know. Estate planning team is an organization that connects the very top financial advisors in the country, tax attorneys, CPAs, and other financial professionals to help clients defer capital gains taxes when they sell these large assets to increase their wealth and to make money on the tax deferred income. KPP Financial is a proud member of Estate Planning Team, and we're pleased to work with them to be able to offer the Deferred Sales Trust to their clients. So what is the DST? As I was doing research, what I found it was really a true exit plan that can convert a highly appreciated illiquid asset, such as a real estate or a business, into a flexible retirement plan or into an investment pool of tax deferred funds that can then be reinvested. More specifically, the Deferred Sales Trust is a specialized type of corporate trust that enables the seller to do all of the following. First, they can sell a highly appreciated asset in medical practices, partnership interests, any kind of appreciated asset where there's going to be a large capital gain. And we're able to use a specialized, what we call Internal Revenue Code Section 453 installment sale to the trust. Utilizing the trust in this manner allows us to both decrease as well as to defer the federal and state capital gains tax, Medicare tax, as well as depreciation recapture on real estate that would otherwise be recognized in the year of the sale. We can then reinvest those proceeds in a wide variety of seller-approved income-producing assets, such as securities, bonds, funds, and including alternative investments like real estate or a new business. Sellers only pay income only pay taxes on the income they receive from the trust, while inside the trust, all of the undistributed earnings grow tax deferred, and they are able to develop a wealth accumulation. So it works very similar to a retirement plan in that it's tax deferred money that gets reinvested and compounds all while being tax deferred. It's also a way that individuals who have this tax-deferred wealth can pass along that tax-deferred wealth to their heirs. So it can also generate intergenerational wealth. It's also an attractive alternative to a 1031 exchange, and I'll talk a little bit about that here in a few moments. And it's also a structure that has been around for quite some time, over 25 years, has a long record of success, and has withstood scrutiny both from the IRS and from FINRA. So they've thoroughly reviewed the DST, and it's withstood all scrutiny that they've had. So what are the types of potential assets that can be sold using a deferred sales trust? Well, businesses and professional practices, commercial real estate, investment properties, high-end primary residences, including vacation or second homes, major private stock positions, valuable artwork and collectibles, including cryptocurrency, promissory notes with a balloon payment nearing maturity, and certain judgments that will result in a high capital gain can all be sold and defer tax with a deferred sales trust. So whenever someone is considering the possibility of selling one of their assets, they usually have four choices that they can choose from. One is to not sell and essentially hold that asset forever or until they pass away and let their heirs inherit the asset. Two would be, if it's real estate, sometimes a 1031 can make sense if a suitable replacement property can be found. Option three, unfortunately, is so often chosen by those who, which is to sell and pay the tax, primarily because they don't know that they can do something different. And today we're going to be really highlighting the deferred sales trust and what that option entails. So here's a sample case of someone who owns a piece of real estate that they're selling, and they are selling it for $5 million. They originally acquired it for $1 million. So they have a $4 million gain that's going to be taxed. And they also took $800,000 in depreciation recapture over that period of time. So their taxes are going to be 20% federal. They're in the state of California, 13.3% state tax, potentially Medicare tax of 3.8%, as well as a depreciation recapture tax of 25%. The grand total of $1.684 million is going to essentially evaporate and go to taxes unless something's done to defer those taxes. So the question becomes, why pay the capital gains tax when you can defer those taxes and reinvest them? So we've all seen and are familiar with the traditional sale, where a seller has an asset, sells it to a buyer, the buyer pays cash for it, and then the seller pays this large tax bill. But the deferred sales trust offers a really valuable alternative way to sell. So with a deferred sales trust, we have the same client selling the same asset with the same buyer, and an offer comes in for what that asset is going to sell for. Rather than putting together a purchase agreement at that point in time, we create a deferred sales trust, a third party to the transaction. As part of that transaction, the trust then becomes the buyer of the asset in what we call an IRC 453 installment sale. So we sign an agreement to basically do seller financing. The seller sells the property or asset to the trust in exchange for a secure promissory note with a stream of payments. This tax code has a really important feature in that you can sell the asset and taxes are not due at the time of sale, but are actually due on the payments that are received later down the road. So we can defer those taxes, and the proceeds, reinvest it, and grow those assets. In the meantime, only the income that's received is actually being taxed. We then turn around and sell that property to that same buyer for the same price that the trust acquired it, so the trust is tax neutral in the transaction. Those tax deferred funds come into the trust, and then we work with the team at KPP Financial to put together a financial plan as to how we want those assets invested. So the client gets complete approval of those assets because these assets are the collateral for the loan. The investments get made, the income comes back into the trust, and if the promissory note calls for payments right away, then those payments start. They're monthly payments that come into the client's checking account, or they could defer payments for a period of time before those installment payments start. So taxes are only paid on the income received by the client. In the meantime, all of the other proceeds, as well as the tax money that was deferred, and all of the undistributed earnings grow compounded and tax deferred inside the trust. So what makes the DST potentially an attractive alternative to a 1031 exchange? Well, first of all, with a 1031, a seller sells their property and the funds are held by a qualified intermediary. The seller then has only 45 days to identify a suitable property, up to 3, and then has to close on one of those specific properties within 180 days. This can be very challenging and very stressful, especially when we have an environment of high interest rates and high prices. If we remove those restrictions by using a deferred sales trust, one can sell their piece of real estate and actually wait for their very best opportunity to surface, not just the opportunities that they can find within a short 45-day period. There's no requirement with a deferred sales trust to reinvest in like-kind property, so you don't have to get back into real estate. You can get into a completely diversified portfolio using the expertise of KPP Financial. However, if you do want to invest some of those funds back into real estate, you have the ability to do that or to put money into a new business, but it's on your timetable, not on those artificial timetables that are present in a 1031. If you do decide to use some money from the DST to get back into real estate, you get a brand new depreciation schedule on the new property that's acquired, which is very different than a 1031 where you have your depreciated basis and a very low depreciation available to shield the rental income from that new investment. So in terms of history and credibility, the IRC 453 has been around, I believe, since 1918, so over 100 years. It's very well tested, and it's very often used for business sales and other types of sales in the market. We've been doing deferred sales trust for over 25 years. They've been thoroughly reviewed by the IRS and found to be compliant. They've been reviewed by national tax law firms. We've created thousands of DST to date, and our tax law firm does provide audit defense for the life of the trust at no additional cost. So some of the benefits of using a deferred sales trust are flexible payment options. You can choose what type of installment payment you want to receive from the trust and let the remainder grow inside the trust. You have liquidity and diversification, ongoing deferral of those capital gains taxes, enhanced retirement income, can maintain your family wealth and pass it along to your heirs. It's a very good alternative to a 1031 exchange. And if you have a 1031 that looks like it's going to fail, we can often rescue that with a deferred sales trust. It's a good way for one partner to sell to another or to sever a partnership interest and defer the taxes that would otherwise be due. And we offer a free tax attorney consultation and setup when you to investigate to see if the DST is right for you. So who benefits most from a deferred sales trust? Well, anyone who has highly appreciated assets, whether it be one or more, which can be sold individually or all together, who expects to have a tax liability of at least $300,000 or more, and usually $1 million of assets or more. However, we're happy to discuss your personal situation, determine how we can best help you to reach your objectives, and if a DST could be a good fit for your personal situation or for someone that you know. So this has been a very brief overview of the Deferred Sales Trust, but here are the steps to follow if you're interested in learning more. The first step would be to contact KPP Financial to schedule an introductory call to talk about your personal situation and see if DST is the right solution for you. If it is a good solution, we'll set up a free consultation with our tax attorney, again at no cost or obligation, to further discuss the situation and make sure it's a good fit. If it is a good fit, we'll complete a DST transaction for you. We'll close escrow. You'll work with Justin and his team to determine your risk tolerance and to develop a financial plan. You'll receive payments when they're scheduled on the promissory note, and we'll continue to monitor and work with you to make sure that your financial plan reaches your overall objectives. I appreciate the opportunity to share this information. It's been a big blessing for me, and it's been a privilege to work with Justin and his team at KPP to help learn more about this structure.
All right, thanks for that, Kent. Let me just ask a couple questions. One, are precious metals considered for a DST? That was one question.
Precious metals, so the IRS rules only prohibit publicly traded securities. So precious metals, cryptocurrency, those types of assets, we can normally defer if we've got a significant capital gain.
Got it. Okay. And then if it's for your primary residence, you still get the 500K deduction exclusion?
You do, yes. So particularly in higher income areas, you may have a substantial capital gain. You still get that Section 121 adjustment to your basis, and then you can really defer that gain, even on a primary residence.
Okay. And then Todd had a question, if it's already in a family trust, would it need to go? Is this separate? And the answer, I believe, is yes, it's a separate trust than your standard family trust.
Yeah, this is a corporate trust. It's used really just to defer these taxes. But it works hand in hand with any personal trust or family trust that you already have set up. Basically, you sell your asset, you're receiving a promissory note, and that promissory note becomes the asset that's held by your personal trust. But the deferred sales trust ensures that we keep that tax deferral in place. If someone passes away, they can inherit the promissory note and continue to have the benefit of that tax deferral.
And then one question was in regards to deferred sales trust versus a monetized installment sale.
Sure, yeah, very easy to distinguish that. Monetized installment sale is an installment sale, but the trust in that case makes a loan back to the seller, which is illegal and against IRC 453. So companies that were advertising monetized installment sale, where you can sell your property, take a note, but then get all of your money and have it hit your checking account and still somehow have tax deferral, those companies are being shut down and those clients are being audited. Deferred sales trust doesn't make any loans. It's not a monetized sale. So it's not the monetized installment sale that you see on the IRS 30 dozen newsletter.
Okay, well, I think that does it. And yeah, I'm gonna finish up here, but thank you for jumping on, Kent, and giving an explanation for that. And I think a lot of people will be able to benefit from it. All right, lastly, I just wanted to touch on if you did need to understand where your portfolio lies in regards to the broader economy. We can talk about your real estate holdings in context, to your broader portfolio. This is something that we do for free, comprehensive portfolio review, looking at broader asset allocation. Are you leaning growth, value, large, small, et cetera? What is your overall breakdown of your individual positions, weightings, et cetera? And then how does that might potentially apply to one of our particular strategies? So if you want to reach out to us, don't hesitate to do so. Just head over to kpfinancial.com, click on the portfolio review button in the top right, fill that out, and we'd be happy to schedule a call with you and go over all of this. Speaking of that, I typically do a live Q&A, but we're running over today. But I appreciate you all tuning in during this hour plus. I have actually a portfolio review to get to right now. So thank you all, and head over to investtalk.com. Have a good day.